Do you know that investing just $50 a week into SCHD, the Schwab US Dividend Equity ETF, could surpass your full-time job over time? Yup, you heard that right. Patience and the power of compound growth. You can turn a small, manageable investment into something that could provide financial freedom. Let us start with a quick story. Over the past 252 trading days, the number of days the stock market is open in a year, we've been investing $50 daily into a mix of stocks, including SCHD. That's $12,600 invested in just 1 year. Sounds like a lot, right? But when you break it down into smaller chunks, like $50 per day or $350 per week, it feels way more achievable. Now, we understand not everyone can commit $50 daily. And that's okay. Even $50 a week can make a huge difference over time. The key is to stay consistent, week in, week out, no matter what the market is doing. Let me ask you, how often are you currently investing? Weekly, monthly, or whenever you have extra cash? Let us know in the comments below, because consistency is the name of the game here. Let's talk about SCHD and why it's such a phenomenal choice for this strategy. SCHD is a dividend-focused ETF that has it all. Solid dividend yield about 3.5%. Consistent dividend growth, and fantastic long-term returns. This isn't just an ETF that sits around and hopes for the best. It tracks down the Dow Jones US Dividend 100 Index with select stocks based on strict criteria like dividend history, financial strength, and growth potential. It's essentially the cream de la cream of dividend-paying companies. And guess what? SCHD also has an ultra-low expense ratio of 0.06%, meaning more of your money is going toward growth instead of fees. If you're serious about building wealth through dividends, SCHD is one of the best options out there. Here's a quick question for you. Do you own SCHD, or are you considering it? Drop your thoughts in the comments. Now let us show you some real-life numbers. Over the past year, we've invested $50 a day into SCHD, totaling $12,600. Here's the kicker. Thanks to reinvested dividends and price appreciation, my portfolio is already up 17.7%. That's over $2,200 in growth in just 1 year. This is the beauty of consistent investing and the power of dividend reinvestment, also known as DRIP. Every time SCHD pays a dividend, that money gets reinvested automatically to buy more shares. Over time, this creates a snowball effect where your portfolio grows faster and faster. But here's an important question. What would you do with an extra $2,000 a year in passive income? Would you reinvest it, save it, or spend it? One of the reasons this strategy works so well is something called dollar cost averaging. Here is how it works. By investing the same amount consistently, you're buying shares at different prices, sometimes high, sometimes low. Over time, this smooths out the cost of your investments and reduces the risk of making big purchases at the wrong time. Think about it. When the market dips, your $50 buy more shares, and when the market rises, your existing shares increase in value. It's a win-win. The key is to stay consistent and not panic during market downturns. How do you handle market dips? Do you buy more, hold steady, or get nervous? Let's discuss, because staying calm is critical for long-term success. Let's discuss how to get the most out of your SCHD investments. Sure, consistency is the key, but there are a few advanced tricks you can use to supercharge your earnings. The first trick is to take full advantage of DRIP, dividend reinvestment plans. With DRIP, every time SCHD pays a dividend, that money is automatically used to buy more shares. This means your portfolio grows faster because you're essentially compounding your dividends. Here's the thing. This works best if you reinvest dividends as soon as you receive them, instead of letting the cash sit idle. Over the years, this small habit can significantly boost your returns. Quick tip. If your brokerage doesn't offer automatic DRIP, set a calendar reminder to reinvest your dividends manually. Another way to maximize your returns is to capitalize on market dips. While dollar cost averaging ensures you're always buying, adding extra funds during market pullbacks can dramatically increase your long-term gains. For example, if SCHD's price drops during a market correction, you can scoop up shares at a discount, locking in a higher dividend yield and better growth potential. But remember, this requires keeping some cash on the sidelines for these opportunities. Don't overextend yourself, but having a buy the dip fund can work wonders. If you're investing the SCHD for the long haul, consider doing it in a tax advantage account like an IRA. Why? Because dividends in these accounts are either tax-deferred or completely tax-free. This can save you thousands of dollars in taxes over time, allowing your portfolio to grow even faster. Outside of these accounts, SCHD dividends are qualified, meaning they're taxed at a lower rate. But avoiding taxes altogether is always better. Even though SCHD is a fantastic ETF on its own, you should rebalance your overall portfolio annually. This means reviewing your investments to ensure you're not overexposed to one sector or asset class. For instance, if SCHD's financial sector weighting grows too large due to strong performance, you might want to shift funds into another ETF or sector to maintain balance. My final trick is automation. Setting up automatic weekly or monthly contributions takes the guesswork and emotion out of investing. It ensures you stay consistent, no matter what's happening in the market. Trust me, automation is a game changer for busy people who want to build wealth without consistently watching the market. Have you automated your investments yet? If not, what's stopping you? Now, as much as we love SCHD, there are a few pitfalls you need to avoid to make the most out of this strategy. Let's go over them so you don't make the same mistakes I've seen others make. The first mistake is chasing performance. It's tempting to compare SCHD to the S&P 500 or a tech-heavy ETF and feel like you're missing out when SCHD underperforms during bull markets. But here's the thing. SCHD is designed for long-term income and stability, not short-term growth. If you're constantly jumping between ETFs based on recent performance, you'll never give SCHD the time it needs to work its magic. Another common pitfall is over-concentration. While SCHD is a well-diversified ETF, it's still focused on US dividend-paying stocks. If your entire portfolio is in SCHD, you're missing out on international exposure, growth sectors like tech, and other asset classes like bonds or real estate. Make sure SCHD is part of a broader, diversified portfolio that aligns with your goals. While SCHD has a low expense ratio, other costs can sneak in if you're not careful. For example, frequent buying and selling can rack up trading fees, especially if you're not using a commission-free brokerage. Also, watch out for account fees if you're using certain tax-advantaged accounts. These small costs can add up and eat into your returns over time. We can't stress this enough. Don't leave your dividends sitting in cash. Reinvesting them is the secret to building wealth faster with SCHD. If you're using the dividends for income, that's fine. But if you're still in the accumulation phase, let those dividends compound. The biggest mistake of all is panicking during market downturns. Remember, dips are temporary, but your investments are long-term. Locks in losses and prevents you from benefiting when the market recovers. Instead, stay calm, stick to your plan, and remember why you started investing in the first place. To sum it up, the key to maximizing your returns with SCHD is to stay consistent, reinvest your dividends, and focus on the long-term picture. Avoid common pitfalls like chasing performance or panicking during downturns, and always keep learning and adjusting your strategy as needed. What tricks or tips have you found helpful for maximizing your investments? Drop them in the comments. Now let's get to the part you've been waiting for. How $50 a week into SCHD could eventually surpass your full-time job? The answer lies in compound growth. Let's say you invest $50 a week into SCHD for 20 years, assuming an average annual return of 10%, which is reasonable given SCHD's historical performance. You'd end up with over $300,000. And here's the exciting part. By then, the dividends alone could generate thousands of dollars in passive income annually. Imagine this. Your dividends are now paying you enough to cover rent and bills, or even fund your dream vacations. At that point, your portfolio becomes a self-sustaining income machine, potentially surpassing the income from a traditional 9-to-5 job. How does the idea of your investments working harder than you sound? Could you see yourself living off dividends someday? Now we have to be honest, this strategy isn't magic, and there are pitfalls to avoid. The first is losing focus. It's easy to get distracted by life. Concerts, vacations, or the latest gadgets. But every dollar you don't invest is a missed opportunity for future growth. Another pitfall is panic. As we mentioned earlier, when the market dips, many people freak out and stop investing. But as we said earlier, market dips are your best friend when you're dollar cost averaging. Stick to the plan and you'll come out ahead. What's been the biggest challenge for you in staying consistent with your investments? Let's talk about it because overcoming those challenges is key to success. Let us leave you with this. Investing isn't just about making money, it's about creating options and freedom. By committing to a plan like this, you're giving yourself a chance to retire early, take a dream job that pays you less but fulfills you more, or even just sleep better at night knowing you're financially secure. So when we say $50 a week into SCHD can surpass your full-time job, It's not just about the numbers. It's about building a life on your terms. And trust me, you're worth it. If you are still not sure of SCHD, here are some facts about SCHD. SCHD, the Schwab US Dividend Equity ETF, was launched in 2011, and since then, it's grown into one of the most popular dividend-focused ETFs. Why? It's all about performance. With a starting dividend yield of around 3.5% and double-digit dividend growth rates for most of its history, it's become a reliable choice for those who want to build wealth and income over time. And its total returns over the past decade, SCHD has delivered annualized returns of over 13%, putting it on par with the S&P 500. To really understand why SCHD has been so successful and whether it's worth considering in 2025, this part of this process ensures that SCHD isn't just selecting high-yield stocks. It's picking high-quality companies with strong fundamentals. Think of it as separating the wheat from the chaff. Now here's where SCHD's structure gets even more interesting. After all the scoring and ranking, the top 100 companies are selected to be included in the index. But there are some strict rules about how these stocks are weighted. No single stock can exceed 4% of the portfolio. This prevents overexposure to any one company. Alright, family, let's wrap this up. Investing $50 a week into SCHD might seem small, but over time, it can lead to incredible results, whether it's $50 a week or $50 a day. The key is consistency, patience, and belief in the process. Did this video inspire you? Tell us in the comments. Thanks for watching, and we'll see you guys in the next video. Until then, stay consistent, stay focused, and keep building that wealth.